start in on classified balance sheet. And classified balance sheet is, we kind of put things in categories. So as an example, if I go to a store and I want Cheerios, where do I go?
To the cereal aisle?
Yep. Sorry, that's my stupid phone. Yeah. Yeah, and now notice I didn't tell you what store it was. I didn't tell you what, it could have been Walmart, could have been Jewel, could have been whatever it is, Everyone knows that if you want cereal, you go to the cereal aisle because the stores categorize all those things that are similar together. All the milk stuff together, all the vegetables. I guess I don't need to explain to you guys what a store looks like, but we do the same thing in accounting. We take those things that are similar and group them together so that people can kind of make some sense out of it. And so that's what we're going to do with the classified balance sheet. It's where we take those assets and liabilities that are similar and put them together. So let's see, is there anyone that did not get the, is there anyone that did not get the chapter, the classified balance sheet handout? Anyone who did not get it? It's in Blackboard if you didn't get it.
Yeah, I got it in my email.
Yeah, okay. All right, so I'm gonna go ahead and pull that up. And so this is kind of our supermarket. This is how we organize things. And we'll explain kind of how those go together. So, we're still talking about assets and liabilities, and assets and liabilities are really what we're talking about classifying. We really don't, the equity section is just the equity section. We just throw everything in there. We don't make any distinctions in that one. But the assets and liabilities, now these are still assets and liabilities. It's just that, we're grouping those things that are similar together. Okay, current assets. These are for assets that will be turned into, I should probably write it somewhere else here. I'm gonna hit a row. That's what I'm gonna do. I'm gonna insert a row. Oops. I think I insert a row above. Okay, so current assets. I don't know. These are for assets that'll be oh, this is a number. I'll try it. Man, I had this all planned out. I thought they can turn into cash or used within 1 year. Oh. Up and down below here. Okay. I know that looks bad. And current liabilities are liabilities that will be paid within 1 year. So current means that these are 1 year assets or 1 year liabilities. So current assets are going to be used or turned into cash within 1 year, and current liabilities are going to be paid within 1 year. I should probably technically should say paid or earned, because unearned revenue would be earn it, can be earned within 1 year. But the idea is the same. 1 year is the cutoff for them. Now, everything below the current assets and current liabilities, everything below here is all long term. So these two are short term, they're within 1 year. Everything below here, everything below the current assets are more than a year. So if something is 2 years, is going to be paid, or you're going to sell it or whatever in 2 years, it all goes below the current asset. So this is only for things that are have a 1 year life, basically. Okay, so let's go through the current assets. Cash is obviously already cash, so we don't have to wait for that when we turn into cash. Accounts receivable, how come that's got 2 lines? I did something with the space. Why did I do that? Oh, no. Well, I'm going to fix this, so it doesn't help you guys, but the next class is going to have a pristine document. Okay, so accounts receivable, those, you're going to collect those. You're usually collected within 1 year. Allowance for doubtful accounts, we haven't talked about this, and I think we get this later on. I think we get this 10%. I can't remember. But allowance for doubtful accounts is that we don't expect to collect all the accounts. As of right now, we kind of assume all the accounts receivable will be collected. However, if you have a large number of accounts receivable, that isn't always the case. 1, 2, whatever percent don't get collected, and they don't get collected for any number of reasons. It could be somebody dies, somebody leaves the country, so whatever it is. You don't always collect all your accounts receivable, especially if you have a lot of them. We subtract those out, kind of like we do for the depreciation. Marketable securities and short-term investments are the same thing. And you say, well, why do I have both of them? Because you see both of them all the time. About half the companies use marketable securities, about half of them use short-term investments. So those two are interchangeable. The new terminology is marketable securities, but you'll see tons of companies still use that term. I think I told you guys this before, maybe I did, but we don't have standards for naming accounts. So you can actually come up with your own names for accounts, and you'll find it all the time. The country that was interesting, and this, I don't know if they still do this, but it used to be Germany. You'd have to put numbers in front of the accounts. So you can name them whatever you wanted, but the account, say, the account 1000 was cash. So anything in 1,000 was cash, and anything was 2,000 was accounts receivable. So you could call them whatever you wanted, but the number told you what it really was. I always thought that was a good idea. Because you refer into some accounts it's called like asset obligations. What is an asset obligation? Supplies, these are usually things that are used up in the business, papers, envelopes, advertising stuff, all that kind of thing. Those are usually supplies. Inventory is usually what you resell. This is what you see that. So supplies are like office supplies usually. paper. Let's see. Stamps, that kind of thing. Those are the things that use supplies. Whereas inventory, you're for resale, and usually inventory, if you're selling stuff for a living, a store, that's usually much. These are the largest current assets going to be inventory. If you look at the financial statements of any retailer, look at Walmart, their inventory is massive compared to the rest of the stuff on the current assets. Prepaid assets, sometimes called prepaid expenses. Those are also current. Okay, investments. Now, investments these are long term. If they're short-term investments, they go in current. These are for long-term investments you're going to hold for more than a year. So this is more than a year. Oh shoot, I forgot that I don't know how to make so anyway, all these down here are going to be for more than 1 year. Everything underneath here is more than 1 year. Okay. Oh, land held for future use. This one is a little bit interesting. I think I'll go to my little dog. Little dog, explain that one. No, the how do I do this? Okay, so suppose we buy a building. And there's some land underneath. Okay, so here's building. Here's the land. So building and land, they we'll find out later. They're going property, plant, equipment. They we'll separate those out. Those are usually you buy the land and there have to be a building sitting on it. That's kind of the way real estate works. But let's say that the land next to it comes up for sale, and you say, well, I better buy that because I might need it in the future. Maybe we might grow and we might need that property next door, so I'll go ahead and buy it. So this is land for future use. And this will be an investment. So, the land and building are just regular old assets, but this is going to be an investment because you're not actually using the land in your business, but you own it. I mean, you own it, so it is an asset. It's just you have on the book as an investment rather than something you're using. So these are what you're using, and this will be the investment. Let me get rid of my phone right now. Okay. And by the way, if you're wondering why I don't just mute the phone, because I never forget to unmute it. And then, oh, your family's in the emergency room. What? We think it'll hold you. Okay, so yeah, so that is kind of that's why we have this one. Help for future use. Okay, property, plant, and equipment is just kind of what it says it is. It's property, plant, and equipment. It's all those things that are properties, land. Plant is usually factories or buildings, and equipment is equipment. So we'll have land, buildings, equipment. Those are, it's kind of it's the most self-descriptive of the categories. And then the buildings and equipment will depreciate. So you'll have accumulated depreciation in here, which we talked a little bit about. So this is depreciates. Okay, down here, I think the space is positive. It's over here. So yeah. Okay, intangibles. Intangibles are things that have a value, but the value is not something you can put your hands in. A copyright is a right to use written material. It could be software or other things too, but the copyrights are that it can't be copied by anyone except you, and they have a value to it. So there's a value to the copyrights. Even though it's not tangible, they can earn money. Unlike these other assets, the building you can walk into. Inventory, supplies, you can go pick those up. The value of the copyright is not in, it's not tangible. I mean, you can, it's a piece of paper, you can look at a piece of paper, but the value isn't the paper. The paper is pretty much worthless. Goodwill is, that's a tricky one. That's when you buy another company and you pay more than the assets are. We're not even try that. But things like you normally see would be trademarks, franchises, patents, big one. And there's some companies that the intangibles are absolutely huge. If you look at pharmaceutical companies, they'll have billions in intangibles, and mostly they're for drug patents. It's kind of wild. You actually have billions of dollars of assets that are not tangible. But, yeah. Okay, any other assets not listed above? And these could be a couple examples. Some weird pension stuff goes in here. If you have,
sorry,
go ahead.
Would tax write-offs? So like, say like you had, say like it was your company and you like hired your kids or whatever, and like you gave them a quote unquote scholarship through the company, and those are like a write-off or a company car, like would that count as an asset since you would potentially deduct that off of your taxes come tax season, or would that be in its whole other category?
It could be. One of the things that goes in there is, for instance, let's say you do have a vehicle that you're not using in the business, but you still own it. And so, like say, like you just said, suppose that your kid is driving around the company car, but they're not working in the business. That could definitely be another asset, because property, plant, and equipment is for things that you're using. So if you have a car you're not using, it could be somebody is not being used in the business. It could also be that it is you're trying to sell it, for example. So anything that's not being used in the business, a lot of times will fall down here. Yeah.
So like it would just fall. I guess because in my brain I'm thinking like equipment would be like manufacturing supplies and like machines. So like anything that is under the corporation's like tax ID would be, and it's a machine essentially, would be like equipment. It wouldn't just be for like work related equipment, I guess is what am I asking that correctly? I'm not sure.
Yeah. Well, cars and stuff will be in equipment.
Okay.
Yeah, they'll have a certain life, and the thing with taxes is kind of different than what we're doing, and not to change the subject, but the government's collection of taxes, they're not actually looking for things that are they have different sets of rules.
That's fair.
They try to encourage different things. They try to discourage current things. When we're doing accounting, we don't do that.
Okay.
So I'll give you an example. If you get fined by let's say you get fined by the government for EPA violation, we write that off as an expense for regular accounting. For taxes, they don't let you write that off. They say we're not going to let you write that off and lower your taxes because you did something bad. We don't have that moral judgment when we're doing the financial statement. If they had an expense for EPA fine, it's an expense. Yeah. So, but what you said though, if you have equipment, especially like something like a car or something that is not being used in the business, it comes down here. That's actually one of the categories. There's one of the things that will get put down. And it could be that you're not using it because it's being used for something else. It could be that it's being you're waiting to sell it or whatever.
Well, like I know that like insurance stuff comes into play when you gotta like register. You gotta get like a business policy for it because it's not gonna be driven for a certain amount of miles. And like, I mean, maybe I'm diving too deep trying to think about that. I just didn't know how that how all that legality came into play when it came to like time for tax time. Because I know all these things. You gotta drive the car like 10% of the time compared to like a consumer vehicle. Maybe I'm just thinking.
Yeah. No, and the insurance, but the insurance is virtually always prepaid, and a certain percentage of that, if you itemize it, can be in there. Okay. You can also just take it by the mileage, which is what most people do, and usually, unless you got a fairly expensive car.
Yeah.
Usually just taking the what they allow you is a better way to go. Anyway, we'll talk about that a little bit next chapter, a little bit in chapter 3, and then later on there's a whole chapter on the depreciation stuff and the taxes come out of that.
Thank you.
Okay, so let's go to so this is the asset side. So, and the bulk of your stuff for most companies is going to be in here. Ooh, that looks terrible. So most companies will the bulk of their stuff is going to be here. It's just bad, or here. They may not have a lot of investments. They may not have any intangibles. They may not have any. A lot of times, you're especially your smaller businesses. This is what you're going to have. Current assets. You're going to have property, plant. So that's very common. Okay. Let's go to the liability side. So these are accounts payable, pay those in the year. Those payable short term, less than a year. Unearned revenue will be in there. Accrued liabilities or accrued expenses. Let me talk about those in a second. But let's say taxes payable and wages payable. Taxes payable, you basically have to pay within you have a few months to pay. And wages payable, if you owe people wages, you got to pay them a certain length of time within 1 year. It's possible that goes into long term if you have, for people higher up in the company, then you get bonuses that are 3 years out or something. But for the most part, this is all current. Accruals are something kind of different. And we actually do this accounting that we're learning is actually called Accrual Accounting. And we have 2 different types of transactions. There's Well, there are actually three. There's cash transactions, which are pretty easy. And we have accruals. And we have deferrals. I probably spelled that wrong. But anyway, accruals are transactions that happen, but the cash hasn't been paid. Like wages expense. So if you have a wage expense, it can either be called a wages payable, or it could also be called accrued expenses or accrued wages. But there's something that is the transaction has happened, but it hasn't been paid yet. Deferrals are just the opposite. Something has been paid, but the transaction hasn't happened yet. This is like unearned revenue. These are much easier to think about because the cash has already changed hands. These are more difficult because nothing has changed hands yet. So you have to go through and see, how much do you owe somebody, or how much have you, are you, let me think here, let's say, well, anyway, I'm drawing a blank here. But anyway, so this is when the cash hasn't been paid. All right. So accruals and well, I know like accounts receivable would be an accrual. You made the sale, you did the work, you haven't got paid yet. So an accrual would be, for instance, if you did work and hadn't got paid yet. So accruals and deferrals are the two, and they sometimes call this accrual accounting because the cash and deferrals are real easy because something cash has changed hands, whereas the accrual, nothing has changed hands yet. So a lot of times you have liabilities that are like this, wages payable, salaries payable, all that kind of stuff. A lot of times they'll call those accrued expenses. Where am I at here? Okay. Long-term stuff, bonds payable, mortgages payable, notes payable that are long-term, more than a year. Bonds payable are sort of like mortgages, but they're usually for much bigger amounts. If you want to buy a store, you can get a mortgage for $300,000, and that's not difficult to do. A lot of places to get that mortgage. If you want to build a factory for $300 million, it's very hard to get one place to write that kind of a mortgage. So bonds payable are usually just, they're similar to mortgages, but they're for big dollar amounts. There's a whole chapter on that. Equity. Some of these we're familiar with, some we're not. We've already had that one. We've had that one. Preferred stock is a weird stock that most companies don't have. It's kind of an unusual stock. It has no voting rights, but it also gets a standard dividend. Additional paid-in capital is basically the same thing as common stock. If I had my way, they wouldn't separate these out, but I'll call them all common stocks, but they do. And treasury stock is interesting. This is when a company buys back their own stock. We'll get into all that later. Okay. All right. Let's jump into a problem. So this is going to be our problem one.
Is equity and stock like different in that aspect when it's like like you're okay? So that never mind.
Yeah, it'll just go right underneath the same account. Yeah, the equity section really didn't change on the classified balance sheet. This is all
Okay.
We just keep it all the same. And we We don't care that much about that. Usually not too much happens in this account, in this heading. I mean, this stuff changes daily, up here, but this stuff hardly ever changes. Okay. Okay, so this is gonna be our problem 1. And you'll notice that this is a trial balance. And you'll notice that there are certain types of accounts that are missing from this trial balance. What kind of accounts are missing? No, I know it's always hard to it's harder to see what's missing than what is there, but I'm going to tell you guys, there's no income statement accounts, right? There's no revenues or expenses. This is what's called a post-closing. Trial balance. We'll talk about closing a little bit next class. But post-closing means you've closed out the revenue accounts and dividends. I should say revenue. Oops. So there's no revenues, expenses, or dividends on here, and this is what you close out at the end of the year. You close those out, and then you can start a new. So for instance, if we're in 2020 and we're going into 2021, well, we're going to close out all the revenues, expenses, and dividends, and start new and say, okay, what are the revenues in 2021? And throughout the year, we'll record those revenues and expenses and so forth. So the revenues and expenses accounts and the dividends get closed out into whatever year. They all get closed into retained earnings, just like we do on the financial statements. That's it. Yeah, so they'll all be closing there, and we start anew, and then we'll, we have our first revenues and our first expenses and all that. We'll start recording. Okay, and here's what we're going to plug them into. All right, let me get mine out. Put the copy over here, and again, you guys can. Let me get this adjusted before I do it. And you guys, you should be able to put side by side your things. I mean, you can also look at it on your own paper. Get my doggy down here. Okay. Close enough. Okay. So I'm going to have that sitting next there, and then I'll go back to my screen. Okay. So let's take the first one, cash. Where is cash going to go? Okay, I'll get us started. Cash is a current asset. So 6,000. Make these a different color. So
Accounts receivable.
Yep.
10,000. Inventory.
Receivable, inventory. Those are prepaid.
Insurance.
Yep.
Land.
Land, we're gonna hold off on that for a second.
Okay.
Prepaid insurance. 1,200. I think that is it for current assets. So what we probably do here is get a total. And we all these together, and I'll show you what we do with it. Okay, so I'm just gonna hand these up. $23,700. Okay, so that's the total current assets. Make them green. Investments, long-term investments. I don't think we have any. No. Probably been equipment. So this is where the land is going to be similar to the property. So the land will be in there. $28,000. What else? I just noticed a stupid error. But land. What goes with land?
Equipment.
Equipment. Yeah. And the accumulated depreciation is going to go with it too. Now it's going to be a negative though. We're going to say, okay, this land really isn't worth 40,000, or this equipment is worth 40,000. It's going to be worth 40,000 minus 11,000. Oops. The handout needs a few tweakings, I'm finding. And you guys can probably see my error. What's my error that I just made? I made the problem to one. It has to do with patents. What's the problem with patents?
There's no price on it.
Anything in there. Anyway, okay, so I'm going to do total property, plant, equipment. So we'll take 28,000 plus 40,000 minus 57,000. All right, now PAMs, we go with the intangibles. And 0. Oh, weird, it's not even centered. Anyway. All right, so basically our total assets. Now, here's the thing about this: it's not going to change the number of assets, the dollar value of the assets. It's just putting them in different categories. So we're not really, there's nothing being taken out really. The assets is just kind of putting them more together. Okay, so I'm going to take 23,000 plus 57,000. 23,700. 80,700. So that's going to be our total assets. And that's exactly the same as before, just like I say, we just categorize it. Okay, let's go to current liabilities. Current liabilities that we had. Which ones are going to go under current liabilities?
Accounts payable.
Yep. I'm definitely going to do some rearranging. Okay, accounts payable was 3,000. Are we going to pay the salaries within 1 year? Probably. And what else?
Would it be bonds payable?
Not yet on the bonds bid.
Unearned revenue?
Yep. Unearned revenue was 400. I think that's it. So our total current liabilities are all those together. Actually, really good in my head. 5,300. Check. So 3,000. Yeah, 5,300. Okay. Now, this is going to be our first kind of use of why we do this. The current assets, 23,700. This is what we're going to turn to cash or use up within 1 year. These total liabilities are 5,300. So that's what we're going to have to pay as we owe for the next year. So the question is, does it look like we're going to last at least a year? Well, yeah, because we have these, we think they're going to be basically turned into cash within 1 year. And these are the things we're going to have to pay off in a year. So yeah, we have 23,000 to pay off 5,300. So this will look like this would be a fairly stable, company for the most part. They have, looks like they have plenty of current assets to pay off their current liabilities. So it looks like they're okay for the next year at least. So this is kind of why we do this, so that you can actually get more information. Just looking at these list of accounts, it'd be kind of difficult to know how the company's doing. But if you see it up here, where it's okay, 23,700 is coming in next year, 5,300 is going out. Okay, I think we're okay. Okay, long-term liabilities. So this is where the bonds payable is going to go. And why are the bonds payable in long-term liabilities? Why aren't they? Why would those be up? It's possible to have bonds payable in the current, but in this case, these are going to be in the long term. Why?
Isn't the balance sheet like yearly or quarterly?
Yeah. No, so the current liabilities, these are for things that are 1 year or less. So anything that's more than a year will come down here. So these are bonds payable are for 8 years. And let me do something. So because it's for more than 1 year, this is kind of the kicker right here. Because it's for more than, I don't know. It's going to come down here. If this was, if you had bonds payable that were going to be due in 180 days, it would be current. So if it's for less than a year, it'll be up here. If it's for more than a year, it's down here. All right, so bonds payable 8 years, 34,000. And I think that's it. We can have, you don't have to write this in, you don't want to, but I'll put it in. If we have more than these, make more sense. Oops. Okay, and our equity section. Equity section is the same as before. So what accounts are going to go in the equity section? And
Common stock and retained earnings.
yep. Oops, that's not how you're supposed to hide. Common stock was, common stock was 8,000. $3,400. All right, so total equity goes to the other, which is 41,400. I better check that. 8,000 plus. Yeah. Okay, so now what we're going to do is I'm going to delete a couple of rows here so I can get this on the same page. Okay, so we're going to add up our total current liabilities, our long-term liabilities, and our total equity. And we should come out with the same 80,700. So let's see if we do. Yay, okay. Okay, any question on that?
No.
Exercise 4-12. I think we'll do that next class. Let's do that next class. Next class I'll do exercise 4-12, and then we'll also do the practice exam.
Sounds good.
So I've been keeping you guys late every day. So yeah, we'll hold off on that. Okay, so don't turn this in yet. Oh, I want to go place 2 turns in. So hold on to this, and we will pick it up next class, and we'll have the practice exam, and the exam will be due a week from then. So
All right, sounds good, Professor.
okay, guys, have a good day.
All right, thank you.
Thank you.
Thank you.
Oops.